We are back with Colin Cieszynski, this time to talk about, Colin, a broadening out in the equity market that has been long hoped for, I think, by many investors and long predicted. And it looks like maybe it's happening now. We have seen, for instance, a significant rally recently in the Russell 2000 index, one of the key small cap indices in the United States.
Very true. And something that we had seen a theme playing out through the spring was we were having really narrow concentration of the stock market. We had a smaller and smaller number of large cap stocks were basically driving the gains for indexes, while small cap stocks and stocks on a more broad basis were struggling, and growth stocks were doing really well, and value stocks weren't. And now in the last few days, really in about the last week, we've seen a reversal of this. We've seen the Russell 2000, the small cap stocks gained over 9% in the last week. This is one of its biggest 1 week moves in decades. It's huge that now people are starting to look to that and to back into small caps. We haven't seen that in a long time. And at the same time, what we saw certainly with yesterday's correction in the NASDAQ is we're seeing that in some of the areas where stocks have moved, we're starting to see some profit taking, and perhaps there's questions about valuations as we head into earnings season. But we're starting to get profit taking in some of the areas that are up huge, and there's a lot of profits and rotation out into other areas of the market that have been lagging.
What does that suggest about the current market rally and whether it is durable or not?
That's a great question, and that's something we're asking ourselves especially after yesterday, because you could make the case that yesterday's sell-off looks like a correction within an ongoing bull market. However, if it started to extend, then it could raise some concerns. But at the moment, it does look like it was just, when we do get these, you get sharp corrections in bull markets, and of course, we know in bear markets you get sharp rallies every once in a while as well. So now we're watching to see today how do things extend, and so far, following the big correction, we're just seeing stocks kind of starting to stabilize here. We'll see how that plays out in the coming days, but certainly we're pretty much almost at the end of the favorable time of the year for stocks. So the most favorable times of the year for stocks are October to April plus July, and then May and June are soft, and then the weakest and most volatile time of the year for stocks is August to October. So we're kind of getting to the end of the favorable time of the year for stocks, and now we're starting to see these corrections as well. So it's something we're definitely keeping an eye on, because we could be moving into a more volatile time of the year.
August to October, and if you stretch it one more month through the end of November, is also the U.S. electoral cycle, and really the home stretch towards the U.S. election. Any thoughts on U.S. election years, this election year, with its several unique features and the potential effects on markets?
Yeah, I mean, certainly we've seen that there's been a lot of obvious twists and turns and unexpected events happening in the U.S. Election, considering what happened with Biden at the debate, what happened with President Trump on the weekend, and who knows what may happen going forward. There's still several months of this campaign to play out, and we've seen even over in Europe, we had the French elections where one weekend it looked like one party was going to win, and the next party somebody else won. So there's a lot of room for twists and turns and uncertainty as we move through the summer and into the fall. And it's something we've seen in the past. We'll recall in 2016 and in 2020, the last two presidential election years, there were significant reversals around the election and around the results. So certainly it's definitely a time where we could be facing some uncertainty.